Nothing in this podcast is intended as investment advice, and the people in this podcast may hold positions in the stocks they talk about. Do not buy any investment based solely on a tip or recommendation. Please do your own research.
Hello and welcome to the Midweek Takeaway. Today we're joined by Pieter Krügel, CEO of Mast Energy Developments. Welcome back to the podcast, Peter.
Hi, Phil. Hi, Kevin. Thank you for having me back.
So the company's just reported record high preliminary January 2025 revenues of £201,000 from its Pyebridge flexible power generation asset, with an average electricity sales price of £200 per megawatt hour, 69% above the market average. December 2024 revenues was revised up 8% to £83,000 following embedded benefits. With the completion of the second 2.7 megawatt genset refurbishment, Pyebridge now operates at 5.4 megawatts, doubling revenue capacity, with a final 2.7 megawatt genset refurbishment planned to reach full 8.1 megawatt capacity. You highlighted ongoing progress with the execution of a definitive funding agreement in Q1 2025 to enhance the growth capital partnership with Powertree, complementing MED's project finance framework agreement with Riverfort as part of its strategy to build a 300 plus megawatt portfolio and establish itself as the UK's leading flexible power generation company. So January 2025 saw record high revenues of this £201,000. What were the key drivers behind this strong performance, please, Peter?
Yes, and thank you for that summary, Phil. That's all spot on. Yes, we're very excited about our January results. It beat our expectations by a fair margin. And I think your question is a very good question, is what was the drivers behind that exceptional performance? And I think it's two key things. Firstly, the fact that we've successfully completed the second genset refurbishment program at Pyebridge, so that additional capacity came online toward the end of December. So we're seeing, a big portion of our exceptional results in January is coming from that additional capacity that's come on stream. So kind of regardless of what the market did, we did expect increased results, which we're seeing. And then on top of that, as a bonus, January saw very big challenges in the energy market in the UK. There were extended periods of low to no wind, which is typically where we then step in to fill the gap. That also comes with elevated electricity prices. And we saw a double whammy in January, where there was not only low wind, but there was also a cold snap at the same time, which drove intraday electricity prices to £1,000 per megawatt hour plus, which we haven't seen since kind of the Ukraine war energy crisis. So I think, all of those together gave us the exceptional results that we saw in January, and we're very excited about that.
Yeah, that explains it. I mean, obviously, having the second genset on explains why you saw the record high revenues, the doubling of that output or the capacity. But also, I noticed you achieved an average electricity sales price of that £200 per megawatt hour, which is just, significantly above the market average, which I think was £118 from memory. So, what factors contributed to this premium pricing there?
Yes, and that's, where we differentiate ourselves from the rest of the market, is to capture as much of the highest electricity prices that we can. So if we look at the average electricity wholesale price for January, that came out at £18, and that's made up of the highs and lows during January, which highs up to £1,000 per megawatt hour and lows, but the average came out at 118. We managed to average out at 200, and the way that we do it is to monitor the electricity price on a 30-minute basis, 24/7. Compare that to the associated gas cost at that same time, and to capture the maximum margin from there. And that translates into our gross profit. So, and that's typically why we always outperform the market average. And if we do our job right, we outperform the market by a significant margin.
Yeah, that makes sense. And I guess the next question is, how sustainable are these revenue levels moving forward? I mean, obviously, as you move the third genset on to reach that full 8.1 megawatt capacity, then it would hopefully go without saying that your revenues will increase with the more megawatts. But I mean, what sort of market conditions could impact any future earnings here?
So the three market conditions that typically impact our numbers are the weather predominantly, and specifically wind. So, if there's low or no wind or too much wind, So either one of those, that creates an opportunity for us to step in, and that always happens. It's just the way that the weather works. There's no 24/7, 365 wind. It just depends on how much or how little wind they are in a particular month. So that's kind of a key driver. The temperature also plays a role. So as I said, there was a double whammy in January, so it was extra cold, which also gives us a benefit. So extreme weather also plays into our favor. So that's kind of the second element. And then thirdly, electricity and gas prices. And that's impacted by so many things globally. But I think the most important thing is that looking at a particular month is important, yes, and January is a very good example of what we can see if kind of everything goes in our favor. But that's one of the main reasons why we give an average megawatt per month, since the start of the overall program, and we're at month 7 now. So our latest average megawatts per month is sitting at 26,500. That's a very good reflection of what we can expect going forward, because that number is made up not out of a single month, but out of a combination of months that's seen highs and lows and so forth. And we'll keep on updating that number to give an indication as to what we can expect going forward.
Very good, Pieter. I mean, stellar results, but ultimately only for one place. So how do we multiply this process so that you do have 30, 40, 50, 100, 300 megawatts as you have discussed on other podcasts that we've done with yourself?
Yes. So getting megawatts into production, Kevin, that's ultimately what it comes down to. And that is very much our focus and plan and strategy, is to get as much megawatts into production as quickly as possible. So our new partnership with PowerTree is going to contribute to that strategy significantly. So we're in the process of finalizing and executing the definitive funding agreement with PowerTree, which will see our Hindlip Lane site, which is a 7.5 megawatt construction ready site, being fully funded and going into construction in the next few months. That will add 7.5 megawatts to our portfolio in production. So that's certainly a next step for us. And then we're also looking at various other opportunities in order to also add to that megawatts in production, all of that this year still. So we're very much focused on that.
Yeah, and obviously from an investor's point of view, with the amount of income that is being generated on a monthly basis, is it safe to say you don't actually need to raise money if these revenues are coming in?
Yes, essentially that's what it comes down to, Kevin. And that was always the plan. Fundamentally, this business, because it's highly cash flow generative, and there's a very healthy profit margin out of this. The more megawatts we get into production, the more cash to MED and its shareholders. So we're certainly starting to build that foundation very firmly now.
Yeah, I mean, you're still working on the 30% gross margin, or
Yes.
It's been slightly higher or slightly lower than that over those months. What sort of percentage have you been working on?
Yes, I think 30% is a fair estimate. We have seen higher, we have seen lower, but I think, again, as with the revenue per megawatt, I think the 30% on average is a fair reflection, yes.
So in terms of the timescale for refurbishing the third genset, Pyebridge, when do you see that decision being made and it actually happening?
So everything is ready to go. We're essentially ready to press play. At the moment, we're just deciding, looking at a few elements and kind of, not only Pyebridge, but kind of just outside of that as well, just getting back to getting, as much megawatts into production as quickly as possible. So we expect to make a decision on that in the short term, but very much firmly planned and, expected to happen soon.
Okay, so that is going to mean that you have 8.1 megawatts. As you said, your average is 26,500, but let's assume for the sake of my maths, because it's easier, 25,000. That's 200,000 revenue a month. That's 2.4 million a year. And at 30%, it's about 725 to 750,000 of free cash flow, which effectively means I think Mast is funding itself, just Pyebridge. So anything else should now add to your bottom line and actually be profitable. Is that fair to say? And for people to understand that that's the metrics that we're going to be working on?
Yes, I think that's fair to say, Kevin. Maybe just to add that from the free cash flow, we'll obviously look to service the debt component of these sites, accordingly. And the view there is to strike a balance between paying off the debt as quickly as possible, but also, getting cash flow into MED and to its shareholders. And there's a fair balance to strike there. If you look at the market and the typical financing structures of these sites, the debt equity leverage is around 60-40. So 60% debt, 40% equity. And the market typically pays off this debt over a 7-year period. And then anything, from there over the lifetime of the asset, which is typically 15 years, all go to the equity shareholders. We think that we can pay off the debt sooner. And one of the reasons is the fact that the strategy that we've established on Pyebridge, where we use the refurbishment program, which is far more cost effective than, going new build, will help, us having to take on less debt and be able to pay that off quicker. So ultimately, we need to get the debt paid off, but we also need to look after Mast and its shareholders, and we'll strike a fair balance there.
Okay, very good. Well, we look forward to more and more progress as time goes by. You've had a good start to 2025. I still don't think your share price reflects what you've got now here. We're only up to sort of just over £1 million in market capitalization. It seems very, very little for the potential you've got now, when you were valued at sort of 700,000 and really before all this started, and I don't say this lightly, it was at risk of going bust, as I'm sure you would agree. So now it hasn't really been realised what's actually happening. So hopefully that will happen over the next period of time.
Yes, fully agreed, Kevin. And I think, with the support of Riverfort, which came in last year and was instrumental in turning Mast around, I think we've established the framework in order to move forward swiftly now, which we plan to do at pace.
Okay. Well, that just leads us to say, Pieter Krügel, CEO of Mast Energy Developments, thanks very much for appearing on the podcast.
Thank you, Phil. Thank you, Kevin.
This podcast was brought to you by Roast PR Limited. If you would like to appear on a future episode of The Sunday Roast, please email admin@thesundayroast.net.